Some CPF members, especially those with a longer runway to retirement, are prepared to take more risk to generate potentially higher returns. This is essentially a life cycle investment approach with a predefined glide path to retirement.
This was the exact moment that piqued my interest when Finance Minister and Prime Minister Lawrence Wong delivered his budget speech where he introduced the CPF Lifetime Retirement Investment Scheme to be launched in 2028. Like many of you, I thought I would just leave my CPF monies alone. Thought it was best to just let it grow on its own, don't invest the money. But with this new scheme, we decided it was time to bring back a familiar guest. He previously came on to explain the pros and cons of investing your CPF money. And by the end of this podcast, we want you to know who exactly the new CPF Lifetime Retirement Investment Scheme is good for and what else you can do if you don't want to consider putting your money there. Back in the hot seat with me is Christopher Tan, CEO of Providend. Welcome back, Chris.
Thank you for having me back.
So before we get into it, can you break down what we know so far about this newly announced scheme, the CPF Life Cycle Investment Scheme?
We don't know a lot because a lot of details are not out yet. But what we do know is that it is going to be a life cycle fund with a glide path, meaning to say that when you first get into this portfolio, if you are young, most of your money will be allocated into riskier assets such as equities, lesser into bonds, which of course we know that in terms of volatility is of lower volatility as compared to equities. And then as you age, it will automatically be rebalanced, moving your monies more into bonds and lesser into equities. And at some point, we don't know at what point, we don't know yet, but probably closer to when you are 65 years old, they are going to sort of like phase liquidate your investments, and then you'll be preserved. And then when you reach 65 years old or from age 65 years old, they will fund your retirement account up to full retirement sum. And then if they are still balanced, then the excess will be put into your ordinary account.
Right.
So that's the whole idea of lifetime retirement investment scheme.
Okay, so essentially you're saying higher risk at the start, higher volatility that you have to face, and then moving into something that's slower, relatively safer, lower risk as well, yeah? So Chris, the last time you were in this seat, we were talking about investing our CPF, right? And I recall you weren't a very big fan of investing your CPF monies, but the way I see it, this new scheme is going to appeal to a whole new group of people, which is going to be more people. Right now, over 1 million people already investing their CPF monies via the CPFIS, which we'll get into later. But I'm thinking, if it's going to reach more people now, this new scheme, right? Are we hopping on the investing made easy bandwagon?
So maybe just to put into context to help people understand, how all these schemes, they fit into the government's intention to improve retirement adequacy. Now, so if we don't realize already, the CPF retirement system is a set of threes.
Right.
So there are three contributors into the account. So the employee, the employer, and the government participates by putting in interest.
That's right.
Right. Then it contributes into the three accounts, OA, SA, and then MA. And then there are three ways now to accumulate these monies into the retirement sum.
Right.
Or rather, two ways now, which is you just keep your money in OA, SA, and then you will grow, risk-free interest rate.
Correct.
That's one way. And then, of course, if you want higher expected returns, you can use the CPF investment scheme to invest your monies in your OA and SA to grow the retirement sum.
Yes.
Come 2028, there'll be the third one. There'll be Lifetime Retirement Investment Scheme, LRIS in short. Right, three ways. And then by the time you reach 55 years old, there are three accounts, OA, RA, SA is gone now. So you have OA, RA, and MA. And then in your RA, you can fund it up to the three sums or retirement sums. BRS, FRS, ERS, or anything in between.
Okay.
Right, and it will grow for 10 years, and from age 65 onwards, you have three annuity plans to choose from: basic plan, standard plan, escalating plan.
Okay.
So it's a set of three, you realize, right?
It's triplets all
That's
the way.
Right.
Yeah.
So LRIS is just when it's launched, one of the 3 ways that you can grow your money from your OA, SA into a larger retirement sum. Now, if you're very conservative, if you don't like to take market risk, then leaving your money in OA and SA, that will be the best thing.
Okay.
You get at least 2.5% from OA now and 4% at least from your SA now. Risk-free, capital guaranteed. You don't have to go through that volatility. That's best.
Yeah.
But if you want to take more risk, then you do CPFIS, right?
Yeah.
But the problem with CPFIS, Andrea, is that you first have to decide the asset allocation on your own. How much into equities, how much into bonds.
Got it.
You got to pick the instruments on your own, whether equities or bonds or the funds.
Right.
You got to know how to choose them. And then you got to monitor the performance. And then as you age, you might have to do that rebalancing yourself.
Correct.
Not everybody has the time.
So it's very DIY.
Very DIY, and not everybody has that knowledge and the experience to do it. Plus, the cost of many of these CPFIS funds, I would say 99% of these CPFIS funds, the fund management fee can be quite high, in excess of 1%, or in fact, in excess of 1.5%.
Yep.
Right? Now, if you don't like to do all these things, and you want auto kind of portfolio creation and rebalancing,
Kind of like a robo-advisory kind of
sort
thing,
of, then it's LRIS. So LRIS is like a package, right? You don't have to do anything. You put your money into it. The asset allocation, the allocation between equities and bonds, automatically done for you.
Yeah.
The funds are chosen for you.
Okay.
The government did announce that they're going to choose 2 to 3 product providers, low-cost funds. They are going to use these funds. So the funds will be chosen for you.
Okay.
The monitoring of the funds will be done for you. The rebalancing based on your age will be done for you. So that's the key difference between LRIS and CPFIS.
Right. Well, I'm suddenly thinking that the similarity between these two is that they're both voluntary.
Absolutely voluntary. And the one key thing I need to say is that both of these schemes, they are privately managed. Your monies are being managed by the fund managers.
Right.
It's not government managed. This is not a government-sponsored, government-guaranteed. You got to take market risk.
Yeah. Okay. Why is that important for us to know?
I think, a lot of times Singaporeans, we complain.
Yeah.
And we like to complain about our government. But at the same time, we place our trust in our government a lot. It's a love-hate relationship.
It is. It's a strange relationship.
And I think it's very important for us to know that this is not guaranteed by the government. This is not monies in your OA and SA. And if you want to invest, you can lose money. You have to go through that risk, right?
Yeah.
Otherwise, well, if you lose money, and you can lose money, you may be very angry and say, how can this lose money? It's the government. I trust the government.
Correct.
Right? So I think it's very important to know that this is not government-sponsored. This is privately managed.
Yeah, and it's absolutely voluntary. It's entirely up to you whether you want to do this or not, right?
Right.
Okay, so I want to go back to what you said earlier. And this is something that you and we keep talking about every time, not just here, but outside the podcast as well, about those risk-free interest rates that CPF accounts give us, right? So the OA has been 2.5% since 1999. No change. Forever. Almost forever. And the SA, the special account, interest rate is 4%, and that's been since 2008. And the latest is that it will be extended till 31st December this year. Now, as you said, these rates are practically unbeatable, risk-free, capital guaranteed. But with CPF LRIS, this new scheme, right, are we saying that these risk-free rates are no longer enough, say, to beat inflation and just to grow our savings? I mean, it feels like we're being told it's not enough. We need to make it grow some more. Again, yes, I understand it's voluntary, but the signaling here is what's confusing to some people, I think.
Yeah, so just to make sure that the listeners are clear, the special MediSave retirement account since 2008, it has been pegged to the 10-year Singapore government securities plus 1%. So actually it's been floated. So it depends on the 10-year government bond rate plus 1%. It is just that since 2008, the government set a floor of 4%.
Right.
that can change, right? And that's why from year to year, we always hear CPF board announcements saying that, okay, next year it's still going to be 4, next year it's going to be 4. But if you remember, during COVID, there were a few times whereby our special account, retirement account, it went higher than 4 because it's pegged to 10-year SGS plus 1.
Right.
But going forward, we don't know. It is possible the government may revert back to this formula and say no more guarantee of 4. It is possible that the 10-year SGS lowers or goes down below 3, and then our SMRA can be lesser than 4. It's possible. I'm not saying it's not possible.
We have to be ready for that possibility. That's what you're saying, right?
Yes. So for people whom they want a higher expected return, even though right now it is guaranteed, then there are options. There's CPF investment scheme, and come 2028, there'll be LRIS, especially if you want a higher return than your OA, because OA is 2.5.
Correct.
Right. So if you want to do that, then now there are two choice, or come 2028, there will be another choice,
right?
Like LRIS. But special account, I think I've said it in the last podcast, I said it all the time, as long as it is 4% guaranteed, please don't invest it. It doesn't make sense at all for you to take your money out from special account just to get a few percentage more, but you are exposed to so much more risk, so much more volatility risk, it doesn't make sense.
So you're saying that if we decide to embark on this LRIS journey, the ordinary account funds are the ones that you might want to sort of use.
Yes.
Because if you are trying to beat the 2.5%,
Yes.
maybe that should be the impetus. Leave the SA alone. Because I think you, along with many other guests we've had on this podcast, always purport how unbeatable that 4% is in the SA. So I get that. Now, philosophically speaking, do we actually need better investment returns for our retirement, or are people just not putting in enough in their CPF?
I think it depends on your needs, right? Yeah, I mean, if you have a certain expectation on how your retirement lifestyle will look like, and as a result of that, you need a huge capital, then obviously you need a higher return to be able to get you there.
Correct.
Right? But if you worked it out and you realize that actually just by putting my money into special account, and then when I reach 55 years old, I top it up to enhanced retirement sum.
Yep.
And by 65 years old, together with my spouse, both of us will have about $7,000 per month for life. And you think that, I think I'm quite happy with that. I think that's enough.
Yeah.
Then actually you don't need to invest. Right? So I've said it before, and I know it's quite controversial, but I really don't believe that everyone needs to invest, especially men in the street.
Okay.
Right? Because if you don't understand investing, and you don't like that market risk, when you invest, you cannot sleep, then I think it's better that you just use the CPF system and get up to $7,000 a month as a couple. And you don't have to worry at night about markets going up, markets going down. You don't have to worry about geopolitical risk. You don't have to wake up and you read the headlines and say, or that says, this country leader, without mentioning names, say certain things,
yeah.
you know.
And it's basically things that send markets into a tailspin. You don't want to have to worry about that, right?
Yeah, then you just keep your money in OASA.
And top that up if you really
and you probably
have the
do
extra
better
cash.
than you invest. So I don't really think that everybody needs to be an investor.
Fair enough. So on the other end of the spectrum, the other extreme is, would it be completely and utterly ultra kiasu to participate in both the CPFIS and the LRIS?
Yeah, so for those who have sort of like done the basic, you know, and they want more, I have to also say that investment is definitely the way to grow your wealth. Right now, if you have got good experience investing on your own DIY using the CPFIS, going through all the things I've said that you must do, and then you don't have to participate in LRIS. But if you want to be like Singaporean, and we are always kiasu, we want to have our cake and eat it too.
Yeah, and FOMO. We have severe FOMO, you know.
yeah. So then, okay, do both, right? So you can put a bid in CPFIS, and just in case it doesn't work out for you, then you still got LRIS. But, you know, Andrea, from evidence, it's been shown that most investors they cannot beat the market. And for those that can, they cannot do it consistently. Even professional managers, they find it hard to beat the market, and they find it hard to do it consistently.
Yeah.
It is better to stay invested in a globally diversified portfolio, keep the cost low, stay invested.
Yes.
You probably get the market returns, which is better than the return which may be better than the returns compared to you doing it yourself.
Okay. I think that's the price you pay for peace of mind in a way, right? So the thing is here, a lot of us use our CPF for housing. And that immediately takes a chunk off out of our OA, right? And if you're saying if we want to do the LRIS and the OA funds are the ones that we should be using more than the SA, I mean, how do we reconcile that? Not having even all that much left in my OA to invest, to participate in this, right?
Yeah, it's real. It's very tough, especially if you are sandwiched, just starting out in your adulthood. You have a house to pay.
Yeah.
It's tough, right? So I would say that, well, if you don't have money in your OA, then you can't invest.
Yeah, correct.
Right? Now, if you have spare cash, well, firstly, you can either use your cash to invest, not LRIS. You can use your cash to invest elsewhere.
Yep.
If not, one thing you can do is to use your cash if you want to participate in LRIS, because from what we know now, things may change, but from what we know now, you can only invest in LRIS using CPF,
yes,
not cash.
Yes.
Right. So what you can do is you can take cash and you put it into your OA.
So you top it up.
Yes, under voluntary housing refund.
Ah.
Right. So you have used money from your OA to buy your house.
Correct.
You can now voluntarily put money back into your OA under the voluntary housing refund scheme. Then you use your money in OA to invest in LRIS. But whatever it is, please don't do it until you have no emergency fund.
Correct.
Right? You don't use all your cash and you pump it in, because once you pump it in, you cannot take out anytime you want.
Yeah. It shouldn't be the first option you seek. You've got to make sure that you are covered on the back end. Everything, all your bases are covered before you even... I mean, that's the same rule before you even invest in general anyway, to make sure that you are covered.
Yeah, because you don't know what will happen. I mean, you may lose your job and you need to rely on an emergency fund. And if you are all invested, then you're in trouble.
Yeah, indeed. You need that liquidity and coverage as well. Scenario time. I'm in my 30s. Never invested a cent in my life. Clearly, it's not me. But I am drawn to the CPF LRIS when it launches in 2028. I'm ready to do it via this vehicle, and I'm sure my financial advisor is ready to swoop in and
say
excitedly... No. I haven't even finished the question yet.
No, but your advisor will probably say no.
Yeah, really?
Yeah,
So, okay, my advisor friend has clients invested in CPFIS.
Yeah, but it's because they make money.
Okay.
This one they don't make money. Can I say this?
Sure.
Just a few weeks ago, before the Chinese New Year period, I was sitting down having breakfast at a hawker center, and then suddenly there was this guy that turned up and said, "Have you started planning for your retirement? Blah blah blah." And then I found out that he's actually an insurance agent, right?
Oh.
And he was telling me all the bad things about CPF, leaving money in CPF, and you should not participate in CPF Life. Why is it not good? And instead buy his ILP retirement fund.
This guy had no idea who he was talking to.
And I'm like, no, you got all the facts wrong. And I was trying to explain to him why he's factually wrong and all that. And then I realized he's not listening. And I gave up.
Okay.
And just before I left, I told him, I said, "Sir, please don't do this. You got to get your facts right. Otherwise, you are not giving your clients the correct advice." Now, so sorry I interrupted, because
go for
if you
it.
are very keen to do LRIS, and maybe if you have an advisor, I have to first qualify. Not all advisors are bad.
Yes,
right?
That's true.
So, but if you have one that is, say, unethical, right, it's probably going to convince you not to do that. Because he's not going to make any money from you investing in LRIS.
Because he's like, what's in it for me?
Yeah, he'll probably tell you do CPFIS because he can make some money from the red fee.
Okay, so if I have a financial advisor who says, yeah, go for it, that's a good financial advisor?
I would think so.
Okay, guess I got myself a good one then. Okay, so finally, Chris, we know you are a proponent of cash savings, making sure you've got enough coverage via insurance, and making occasional top-ups to your CPF to build a decent retirement nest egg. I'm such a good student of yours. So come 2028, 2 profiles here. Would you get your daughter to give CPF LRIS a shot? Because I understand she's in her 20s?
24.
24.
And my son is 28.
Okay, so would you get your kids to consider, read up on it, and then, try it out?
Well, now I think it depends. Okay, it depends.
Okay.
I think for my son especially. So my son is quite savvy as an investor. And I think he doesn't need to make use of LRIS, right? Because they are available low-cost funds and he is already investing in these low-cost funds. He knows how to do the asset allocation himself. He knows which are the low-cost funds that he can pick. He probably should continue with CPFIS if he's using his CPF money because that offers him a lot more flexibility. For my daughter, well, she's investing, but she's less interested in investing. If I can educate her in how to invest using CPFIS, what are some of the instruments you can choose, then she can use CPFIS. But otherwise, well, if she's lazy and she doesn't want to learn, LRIS is a good option.
Okay.
But regardless, and I'll tell both of them this, that you should actually make use of the low risk or almost near risk-free interest rate in your OA and SA. And if you really want to try using your OA money to invest, start small.
Okay.
Experience a bit of it first.
Try it out.
Yeah, don't, in one shot you transfer $100,000
Wow,
into
no,
it.
yeah.
Especially if you're listening to this and you are a new investor, I would say learn about what investment is all about. And then after that, put small money, $5,000 or maybe even $1,000. Try it out. Experience what volatility is like. If you feel that you are okay with it, then slowly move it in. There is no need to rush.
Yeah.
Yeah, that's what I'll say. And finally, don't take away all the money in your OA to invest. I mean, right now, the first $20,000 you cannot invest.
That's true.
But consider maybe setting aside even slightly more, because just in case you lose your job and you can't find it, you cannot find another job in the next 2 years. I know of people who cannot find a job until 2 years later.
Yeah.
And if you've got a mortgage to pay,
That's right.
at least you have some emergency money in your OA to pay your mortgage.
That's right.
Yeah.
Okay, the other profile is you. You have taken out your CPF money.
No, I didn't take out. I left it in the OA.
Oh, you left in the
Yeah,
OA. Okay.
but I'm 56, so I can take it out.
You have come to the valid age to take out CPF monies.
Ola.
I'm just trying to be nice here.
Okay.
Would you do it? With a shorter runway, would you do it?
I wouldn't. Yeah, I wouldn't, because at this age, if LRIS is to be around, and if I put my money in LRIS, most of my money will be in bonds, right? And for me, I don't want a lot of my money to be in bonds. I would rather keep my money in OA, 2.5%. I have liquidity because I'm old, 56, right? I can take out anytime I want.
Yeah.
I'll leave it there. I've got excess cash, right? So I'd rather use my cash because my cash is attracting a lower interest rate. So I use my cash to invest, and I can decide the asset allocation I want based on my needs. So I wouldn't.
Okay. All right. Thanks for indulging me. And thank you for, always taking the time to sit in this hot seat and answer these very difficult questions. But, it's when it comes to the CPF, you really, truly are our beacon of knowledge.
Thank you.
So thank you for taking this time.
Thanks for having me again.
And to you, the Money Talks community, thank you for tuning in. I want to leave you with a question now. If you had a moment with our finance minister, what would you ask about this new CPF scheme? Let us know in the comments wherever you're listening to us from. You can also email us directly at cnepodcasts@mediacorp.com.sg. I'm Andrea Heng, signing off for the Money Talks podcast.